Mahesh Patil joins us. Let's take the conversation forward. He represents Aditya, Birla, AMC. Mahesh, great to have you back. Thank you for joining us.
Yeah, good morning.
Earnings are here.
Yes.
Markets are here.
So I think earnings are, markets are always anticipating future earnings, right?
But they're not coming.
Yeah. So I think this year, again, there has been a kind of a downgrade to earnings, what we were looking at the beginning of the year. But as you move forward, again, the base becomes favorable, right? So the next year earnings growth looks very good.
Well, it's great that we everyone can have a laugh about
think,
it, right? This morning.
Yeah, I think the fact is that, there are, some challenges. This last 2 quarters, we've seen the GDP growth slow down materially. And that has hurt the earnings growth across, though the tax cuts have kind of given a kind of a prop. So they have, so despite the downgrades, what we would have said otherwise, I think the earnings growth this year are still looking at around 15% growth, which is not bad. Right?
Why
but has the sentiment changed from where it was a month back? It seems so, looking at the prices.
Yeah. So I think sentiment has, there are 2 things happened, which is one is on the global front, clearly, because of the, again, the easy monetary policy globally, a lot of these central banks have become very dovish. We have seen liquidity, again, global liquidity and money supply has started to increase again, which was contracting last year, right? When we saw US kind of tapering. Again, we have seen US going into a QE, EU again talking about a fiscal stimulus. So the money supply globally is again improved, and that is giving a view that, feeling that you will see some revival in global growth also, which was kind of slowing down for this calendar year. So I think that has changed globally, and we've seen money supply coming in, money flow back into the emerging markets, and last 2 months we have seen FI flows have been positive. So that has helped. And on the domestic side, I think while there has been a slowdown, clearly there is, government is doing its bit now. Okay, there's a clear acknowledgement of the slowdown, and various efforts are being taken to address the slowdown. Either recent tax cuts which were announced, or trying to address the problem in the NBFC sector, providing more liquidity into the system. And that is giving hope that things are bad. Equity is not about the current, but it's looking into the future, right? While the current earnings are bad, economic growth is probably the print. This quarter will be the slowest what you will see, but things will start to improve from here, right? Rate cuts also what we have seen, slowly transmission of that will start to happen. So all these, if you look into and bundle into this thing, then market is feeling that worst is behind us, and things will start to improve.
Mahesh, but the high frequency data, and I'm also a bit disappointed, maybe disillusioned with the data which has come out last week. Inflation at 4.5% higher, largely because of vegetable prices, bad news. SBI economist, who's an optimistic economist, making a case that the GDP is going to go below 5%, again bad news. Telecom is an absolute disarray. Imagine if any of the telecom companies goes away, what stress it will cause on the banking sector. And then on top of that, you've got auto companies which are saying that the uptick which we thought will happen because of festival season is behind us, and November we are not off to a good start. So what is that data point which gives you confidence that, look, the worst is behind us and there is light at the end of the tunnel? Because for me, every time I think we are nearing the end of the tunnel, it just gets darker only.
Yeah. No, you're right. So, market probably is slightly ahead. I would agree that in terms of fundamentals. So if you look at we've seen the negatives, right? What are at the margin, okay, what are things which could one can be positive about, right, going from here, at least from economic standpoint. If you look at what caused the slowdown in the economy in the last 2 quarters, I think that will give some answers to that. So, first of all, we've seen that the government's spending contracted quite a bit in the last 2 quarters because of elections, and that money started to flow back into the system. We've seen government starting to make disbursals. So that supply from the government side is slowly starting to come in. Rural economy has been fairly slow. We've seen the commentary from some of these consumer names. They've seen there's a slowdown, even for the auto name. While this monsoon again has created some kind of a havoc because of the retreating monsoon. So this season might still not be that great, but it bodes well for the Rabi crop, and the water levels are good. So you should see, rural economy, not this first half, but second half should start to look up. So that would help consumption a bit. Rate cuts, we have seen around 135 basis rate cuts in this calendar year. The transmission has been slow. So a lot of companies and corporates who actually want to borrow, their rates are still fairly high. Spreads are still very high. I think that will slowly start to normalize. Again, the problem in the NBFC sector is still not over, but I think there are enough remedial measures which have been taken over there so that there is no contagion effect. Also, the good news is that wherever there have been companies which have been under problem, see, because of the global risk appetite coming back, there is, again, money which is coming back. So we've seen a lot of investors, whether PE funds or other investors, coming in and trying to buy some of these distressed assets. Even some of these NBFCs, okay, which are kind of facing challenges on the liability side. We have seen some investors coming in. So I think that will slowly, I think, settle down a bit. We'll see interest rate transmission slowly start to happen. That will help to stimulate some amount of demand also on the retail side, I would say. So these are some of the positives, I would say, okay, which again, I would agree that you would not see a sharp recovery from here. It will be very slow and gradual recovery. Market at this point are probably factoring most of the stuff. So you might not see a big upside from here from the market from a near-term perspective, I think. But I think the valuations globally, if you look at it, because of the easy money and the low interest rates, are fairly high. So probably it might get into a consolidation phase from here.
So what has the strategy been at Aditya Birla? In the last 1 to 2 months, what sectors have you increased or reduced exposure to?
So again, in this kind of an environment, not done too much but clearly a few sectors where we would have looked like in the financial services sector, in the insurance space, in the last 4-5 months, we have increased our exposure because again, sectors or companies where there is steady earnings visibility or steady growth, I think those are sectors which one would want to be in this kind of environment where there are challenges across multiple sectors. So insurance is one sector which we find steady growth. Valuations are now again kind of pricing in a lot, but yeah, we see a steady compounding over there.
Pharma is read into the insurance data. I mean, I'm sorry, I just have a follow-up question on insurance. I don't understand insurance that well, because it's a very new sector for us to understand. So we just wanted to understand from you and for the benefit of our viewers, what is the right way to value an insurance company? And when you look at the data which comes from IRDA, which talks about new premium selling, right? There is a decline from 20% to 7% for 3 months in a row.
Right.
Is that temporary? And if that is temporary, then why markets are excited about buying insurance stocks?
So I think insurance, again, when you look at the headline numbers, right, just like a top line in a company, which is a sales number, right, that is showing weakness because ULIP, okay, which are linked to the market, okay, they are probably not growing as much. That is the adjusted premium equivalent, APE data, what do you call it, which is the equivalent to a top line for a company, that is showing some weakness. But what is happening in insurance is that the more profitable products, right, which is more protection, okay, there the growth is fairly strong, and because of still there is under penetration in that category, and a lot of companies are now focusing on driving protection products, where the return on ROE, as you would call it, is much higher. So the mix is improving. So as a result, the operating profit, okay, growth is much stronger, while the sales top line growth is weaker in a normal parlance if you compare with any other company, and that is what is looking good. And it's a more distribution product, right, on the protection side. And as you penetrate more as bank drive distribution, we've seen that that's not linked to the market vagaries, ups and downs. So that is what is providing a steady growth to the earnings or the operating earnings for the insurance company. And that's how you value those companies on the, not on the top line, but on the ROEV.
Okay. You're actually bullish on Telecom. Let's talk about that, because that seems to be the topic of the day and of the week, really, given all that's going on. And, we are hearing that there is going to be a quantum of a hike. So, what are you expecting with regards to the pricing environment and how things will shape up?
So, I mean, clearly there are, it's reached a point, okay, where a couple of players, the overall profitability has come to a level where, because of the government intervention also, we've seen there is a scenario where we're seeing the operators are willing to now take a price hike. And it's going to be a long way, though, because each companies would have different dynamics depending on how the operating ratios are and how the debt burden is, right? Because that is what will decide in the longer term which companies will survive. Having said that, I think the environment clearly on the, we've seen the largest player who was kind of aggressive in the market, has taken some indirect price hikes, and that's given room for the other players, the incumbents, to also take price hike. And the scenario looks like finally the price war has bottomed out, and if somebody has to earn a decent return on capital, I think there is room for more price increases down the line. And that will be, I think, positive for the sector in terms of news flow, in terms of growth, because we're not going to see more growth coming in because of increase in penetration. We have driven penetration sufficiently. Obviously, there will be move from people migrating from 2G to 4G. So data customer base would increase. So that will drive increase in ARPU going forward. So we are fairly constructive from the sector. Again, it has to be looked on a company case-to-case basis. But directionally, I think it looks like the EBITDA numbers and this thing growth will improve from here.
Where have you reduced exposure? You talked about the spaces that you're bullish at, but what is not good to be in this kind of a market?
So we have reduced exposure in metals earlier because though I think, again, there is some kind of a response that could see some upside in the metal space, but by and large, overall global growth outlook will still remain fairly tepid. So metals are the place where we were very positive last year, but yeah, we have reduced weightage over there. We underweight that sector. We have slightly reduced weightage in the consumer side because of the valuations, though there is nothing too wrong over there in terms of the slight slowdown in growth, but stable company. But purely because of valuation reasons, we have reduced our weightage in the consumer staples. So we are still positive on the consumer discretionary, consumer durable names. And autos, again, during the early part of the year, we reduced exposure in autos. But again, we are reevaluating that because, again, there we are seeing some kind of bottoming out in terms of the volume degrowth, what we have seen in the last 1 year.
Okay. You know, you've clearly said you're still sticking to the, the nifty companies, the companies which are market leaders, which you still see as growth companies going forward. Selectively looking at mid-caps, but gradually over the next year or two. You know, how should one read that? Because we've really been talking about whether or not expanding one's portfolio, looking now into mid-caps or further opportunities is a signal that things are going to get better. You know, should we read it as that? Is that how one would interpret it? Or just that that's really where you see more scope for return in the Nifty?
So if you look at last 1.5 years, the market rally has been fairly narrow. Few stocks have done well. And so there is a valuation divergence which is there across within large cap also and within large cap and mid cap space. We're still early days. I mean, unless the domestic economy gains significant traction, we won't see the mid and small cap really participate across in a big way, right? So it's not going to be across the board, but selectively because of the lack of interest, you would say, in the small and mid cap space, there are quite a few stocks, okay, which are available at reasonable valuations. So it's more about a valuation call, stock specific, which we are looking at to really add in some of these in this area. I think if you see the domestic recovery starting to play out, then there will be wider participation of mid and small cap space across the board. So it will still be selectively. Again, companies which are again in mid and small cap space, we have seen a lot of pain because where companies have had high leverage or where there were promoter concerns. So I think one would still stay away from those names because the kind of mishaps and the correction, the risk in the mid and small cap still remains fairly high. We're not seeing a broad-based rally, at least in the near term. But if you take a 3-year view and try to build up a portfolio, I think there are enough pockets of value in the small and mid cap space.
Mahesh, if I look at the quarterly performance, what has demonstrated growth? Bajaj Finance, HUL, Asian Paints. Big companies have gained market share. Small companies have suffered cost of capital, inflation. A lot of factors are at play. So our market's telling you that, look, these are expensive companies, but in this downturn, they are the ones who are growing. And that's what the messaging is. I mean, we may find it optically expensive to look at a Trent or a Bajaj Finance or an HDFC Bank. I mean, the list is very long.
Right.
But if that's where the growth is, and if that's where the market share gain is, so be it. I mean, what's wrong in just sticking to those 10, 15 stocks?
No, so I would agree. So I'm not saying that one should be totally, but what these companies will continue to do well in terms of earnings, right? But somewhere down the line, I think as the markets, and we have seen this cycle, right, where liquidity and risk comes back, okay, you would tend to move across down the spectrum. And other companies where they are depressed, there are multiples are depressed, earnings also depressed, right, because of the slowdown what we have seen. So you're looking at companies, where do you make big returns in the market, right, over the medium to long term. Companies where there is a potential of higher earnings growth and P re-rating. So some of these larger companies, they have steady earnings growth. You're not expecting a very large because the earnings, they have been doing well. And the P multiples are fair. So there is no kind of a P re-rating scope. So they'll continue to grow at the pace of earnings probably, which could be around 10, 12, 13, 14% in that range, which are good. So they provide stability to the portfolio. So it's not a time to really move out totally from some of these large names. We're still having them in the portfolio. Incrementally, one can add companies which are earnings are depressed, where you could see a recovery, cyclical recovery or otherwise in earnings and some potential for P re-rating over the next 2-3 times, where you would have in your portfolio to generate that alpha.
All right. Mahesh, thanks so much for joining us this morning. Always a pleasure. And you have a good day going ahead.